Hello and welcome to the Enlightened Investor, broadcasting from beautiful Peoria Heights, Illinois. It's been a little while since we've been with you all, but we've got a great show today, really talking about valuations, how you can maybe optimize the next 10 years of your return. There's a lot of return to the mean going on here, and the Warren Buffett quote about the market can stay irrational longer than you can stay solvent. It kind of comes into play here when we're looking at valuation. So stick with us today. We got a great show on how maybe you can set your assets allocated so where you can maybe have a potentially even a better return in the next 5 years. Can't tell you for sure it's going to happen short term.
Educational purposes only.
Educational purpose only. But if things kind of revert to the mean, there's a couple plays you should be aware of. So with that being said, Mike, maybe you could talk a little bit about valuations just briefly and maybe kind of return to the mean idea. And
I think this is great. This is something we've alluded to in previous issues, and this is good data that got put out here by one of the guys in my back office, and I'm going to kind of regurgitate it, and I apologize for the allergies and the cold today, but it is what it is. So I think this is very common because when you look at most people's portfolios, you think about it. If you're an advisor and you're building a portfolio from somebody, you want it to look like the market, right? Mm-hmm. Because that's the measure they're going to measure you, or the benchmark they're going to measure you against. So they're either going to use the Dow or we're going to use the S&P. And if you look at the S&P and some of the data we're going to look at today, it's like 25% of the S&P is 5 stocks right now. And I think the data showed there was a huge valuation difference. So the point being is you can probably do better long term if you're more diversified. But you've got to be able to handle periods like this, like the last 13 years. The S&P has looked phenomenal. But it kind of goes back to we've been here before, back in the late 90s when the dot-coms were going on. And the worm turned very quickly.
Yeah, I love that quote. The worm turned.
Yeah, and we'll look at that.
Yeah,
so it's not chasing the big. And then if you're chasing individual stocks, I'm sure people like that too. I hear a lot of that. What's your pick? What do you got? And Nvidia, Google, some of these with the AI trend, they've done phenomenally well. But as we're going to show the data today, I mean, the future prospects for those returns probably aren't as good because. If you want to look at stock performance, there's some basic things about valuations. And first, know that expectations are built into every stock price. And then what you see if you look at the empirical valuation theory, what it teaches us is that a stock price is the combination of current value and future expected cash flows. Mm-hmm. And we're going to look at that data. And there's more popular ways to look at it. If you look at the actual earnings to yield ratio, and it's that is the inverse of the price to earnings ratio. And it's like a bond. The higher your earnings to yield ratio, the higher your prospects for future returns are. Mm-hmm. And so we're going to do is we're going to take a look at the market versus value, the market versus small value, market versus international today with those valuations to kind of get a sense for why it might make sense to, if you are heavily weighted in just a market weighted portfolio towards that growth, that you want to be more diversified.
Yeah, so I think these thanks for setting that up for us, Mike, today.
Sorry, really boring stuff.
But this is where the real strategy comes in with regards to longer term investing, right? This is the strategy comes in.
Diversification and discipline, because it's tough. Well, you get people that they look at just the last 12 or 13 years here, and if you're weighted towards the market portfolio, which most people are going to be, because that's so much simpler from an advisor or a retail product to say, the market's up, we're up, market's down, we're down. So you're going to have different tracking if you diversify differently. But this, if you look at this data right here, we're going to look at 3 different sets of data. This is showing, this is the S&P, and it's plotting the top 5, Amazon, Nvidia, Apple, Microsoft, and Google, very low earnings to yields. But like I said, again, those 24% of the index are in these 5 stocks, and they're worth 10 times the rest of the index, but the yield is half.
So the market cap has really blown up for these large, like the way they call them, the 7 sisters.
Right, there was actually 7.
7 of them, and on the graph they mentioned 5. But those companies, if you've been in, Warren Buffett, folks, he's got about 50% of his portfolio in Apple. So when you think about, it's about 45, 50%, right? So when you think about Warren Buffett, he took a fairly significant risk on, and it kind of paid off for him. But will it pay off in the future? And that's the other big question.
Well, NVIDIA tripled this year.
Yeah, NVIDIA tripled this
How about
year.
that, huh?
Yep. So anyways, these large tech stocks, they're leading, they might not lead in the next 10 years.
Right.
Just like, the whole reversion to the mean idea. And can I ask you one more question, Mike? What do you think about the winner takes most idea? We hear oftentimes with active managers like Kathy Woods, like, hey, get into these big seven sisters tech stocks because they're going to be the ones that just continue to roll on. What's your thoughts on that?
I think the simplest way to think about it is reversion to the mean.
Reversion to the mean,
Forget about valuations or anything else. I mean,
Yeah.
You're going to revert to the historical mean at some point. So if you're way above the historical mean, the odds are pretty high that you're going to probably revert to it. And what's amazing too, and I didn't, I'm kind of digressing from our conversation as far as the data we have today, but I mean, you look through history, there's always leaders, right? In top 10s and top 5s. But if you look through history, they disappear. Because you get something new that's hot. So, yeah.
Give me a couple examples, like General Electric. Remember RCA back in the early 1900s?
Polaroid.
Sun Microsystems from the producer.
I'm not adverse. If people want to play with a little bit of their money, I get it. It's kind of great to kind of hope you're going to go out there and hit the next home run. But, I mean, when you're talking about the bulk of your money, you want to be diversified, you want to be disciplined, and I think that's why looking at this helps. And so this second set of data here, let's talk about that here.
Second set of data on...
I mean, the whole focus is still, when you look at the data with the yields, everything is based, driven around the S&P. It's really, nobody wants, like you look at small value, the yield is much higher compared to the S&P, and that's just because they're buying up the large stuff and they're not wanting anything to do with the small value. And basically, I mean, if you look at the years, this goes back to 2008, small value is doing worse than it did back in the 2008 crisis. So it's already factored in our deep recession based on small value stocks. And
so small value, folks, is undervalued, underpriced.
Highly underpriced right now compared to what the historical numbers have been.
If you're looking toward, we don't know the future, but if you're looking forward to seeing reverse, if you look for reversion to the mean, we're going to see probably some
just
nice.
In a simple manner, forget about the valuations, right?
And what about international as well? So we've been talking about that for quite a while now.
For 15 years, and I see this a lot. I have a lot of people that have aversion to wanting to own international because you want to stick with what you know, right?
Especially people in the Midwest here, right?
And you go back to the last decade, which would have been 2000, 2009. International looked great along with small value compared to the S&P, but since then it's been the opposite. So. Recency bias, right? When you're thinking about things like that.
Recency bias, and really, when it comes to things turning quickly, you mentioned how 1 year could be a big difference, Mike. Like when you look at this.
I like this data. I kind of drummed this up. This is kind of a supplement to this article and the whole conversation, but I recall this. I mean, and this goes back to, on the left here, what they're looking at is two empirical academic indexes. It's a Fama French growth index, Fama French value index, and they're showing all the way out 15 years returns. And the first one is ending in March of 2000. This was the end of the dot-com boom, and you had 15 years where growth outperformed value. But then you just go 12 months later to the right there, March of 2001, and the worm turned so much that the 15-year numbers were better for value than growth. Yep. So even though it looked fabulous and everything, if you stayed where you were and you weren't diversified, you gave it all back.
Yeah. And, people will say like, hey, you just selected numbers there or whatever. But the fact of the matter is the tracking error can persist, ladies and gentlemen, but it can't persist forever. And I think that we're showing you some information here, just easy stuff to look at.
History may not repeat, but it rhymes.
I'll take that.
Okay.
So what do you think? Is that a good day for the Enlightened Investor?
We threw a lot of stuff on the wall, but hopefully people grab something from this. I think it's informational.
Well, folks, thanks for joining us today. Just some good basic information about valuations and how to think about a different perspective than just owning the market. So hope this helped, and we'll see you in the next show of the Enlightened Investor. We're out. Take care.